where most people were predicting the most anticipated recession that's never happened. I think a lot of people were very conservatively positioned and they're trailing, so they're trying to keep up. And the other thing is that so far there's no evidence of a recession. So as long as there's no evidence of a recession, I think the market will probably continue to melt up.
Woo, baby, we are in one hell of a precarious situation when it comes to the bulls and the bears with the events that are about to take place this week in the market. With first and foremost, the Federal Reserve speaking tomorrow, obviously between Tuesday and Wednesday, giving insight into inflation, interest rates. They're going to stop raising. Are they going to continue to raise? What does inflation look like moving forward? And then in the midst of that, we're talking about another crazy earnings event here. Last week we had Tesla, a lot of the tech companies that posted with bought stocks that even with great earnings were still able to sell off. And tomorrow we're getting some of the undervalued dividend players posting the morning. Verizon, 3M, some of these companies we've been following. And then into the after hours, we're talking about Microsoft and Google midweek with Meta. A lot of these tech companies, we're going to see if they are truly overbought, if this is going to be a profit-taking scenario. And if Tesla has anything to say about it, maybe these earnings will actually be pretty decent. But there's a lot going on to pay attention to here. But on the interest rate side of things, we could potentially be seeing the first soft landing that has ever happened in an economic event like this. Obviously, housing pressures, there's a big supply and demand mix, so people are absorbing these interest rates, and there still seems to be decent sales going on. There's no crash, there's no correction there. Unemployment is still remaining very strong, which is going to sustain this higher interest rated environment. However, the biggest cause of concern when it comes to interest rates, which Canada and the US seem to follow suit here, is commodity prices, because right now, we know inflation has been falling off to a more nominal level. If it consistently stays down here, we'll probably get into the end of the year, probably start seeing interest rate cuts start happening next year. But obviously with commodities, people get excited. If you're investing in commodities, you're playing in this realm, you want them to go higher, but realistically, it would not do good for the economy. If they raise rates more than they have now, we're screwed. There'd be no coming back from interest rates getting into the 6 and 7%. We're kind of like at the breaking point, I think, for most people. So we really need to stop going up with everything. We need some flatlining in the markets. But honestly, I think if stocks go higher, people keep making money across the board. That also is going to put pressure on what people are spending money on and probably keep inflation a bit higher as well. It is a real catch-22 of everything that is kind of taking it into the combination that you'll never be able to wrap your head around. And that's why things are just in the market pure fugazi, and you shouldn't invest based off this news. You should obviously just cost average. It's the best thing you're going to do to survive any of this, which is something everyone should sustainably always try and keep a level head. But here we got Fund Strats own Tom Lee, who's been in the CNBC television news for so long, because this dude was calling these bull runs, got it pretty much down pat. But here's his insights, and even he's kind of getting bearish at this point.
Something in your notes, though, made me raise an eyebrow. You say we also have to recognize stocks have advanced sharply in the past month, so profit-taking is healthy. Tom, profit-taking is healthy here?
Yeah, I think profit-taking is healthy because I think that's going to be part of the investor mindset. Investors who've been involved with tech and FANG are enjoying pretty stupendous returns year to date. Now, it doesn't mean that when they take profits, they have to necessarily exit the market. But to me, next week is a story of, well, if the Fed surprises us in a way because it's more of a dovish pause, I think investors are going to look for ways to sort of find stocks that rise on easing financial conditions. And they may not come back to the FANG. They might stick with tech, but they might broaden out into industrials and financials. So yes, profit-taking, but doesn't mean the market has to go down.
So he's got like my literal bull thesis here, which is basically the lower half of the S&P, where all these stocks that have been trading at discounted values, especially in the financial sector, because even though they still have pressures on the banks, that doesn't mean people aren't going to still see that as a discounted buying opportunity, and they might take that profit out of tech and start redispersing it elsewhere. And it's funny that Tom Lee kind of recognizes my same bull thesis here. And taking a look at the markets just as it sits in this current moment, everything has actually been doing exceptionally well. Like, I've been going up every day on the banks. VOO, even with the tech sell-off, has still been able to rally pretty nicely here, though tech is coming back up a bit today. The banks have been rallying incredibly. Look at TD is up another half point. National Bank's up 1%. I primarily just play the Canadian banks, and that's been working excessively to my favor in the last week here. Even Tesla's been starting to pick up some of the losses that it had. As somebody that really wants to see tech sell off a bit more, I would like to take some good buying opportunities. We'll see what happens with that. I've been pretty bad lately at actually trying to time any of the tech companies, which is why I just recommend, again, Again, pick your favorites, cost average, easiest thing to do in this macro environment. Bitcoin selling off a little bit here, but the markets have just generally been flatlining. These little bumps today don't make up for the losses that some of these tech companies have experienced, especially with things like, you take a look at Meta here over the last 5 days is still down 6.2%. A little bit of healthy profit taking, but if we are truly in this new bull market, what we'll probably see is a bit of a hiccup here. I don't know how low it's going to go, but my guess is this is where you'd probably be best to start buying if you truly believe we're in a new bull market, because give it another couple months and people will just be picking up the dips and we'll see things start to pressure back to probably their all-time highs, give or take. Again, that's purely speculative in nature. There's no guarantee that's going to happen, but we'll see what happens here, especially with how bullish those Tesla earnings were, way more bullish than I was predicting them to be. But I'm more intrigued by obviously things again like Verizon here. These stocks have been unfavorably beaten into the ground along with financials, industrials, some other sectors in there for trading at a 6 times multiple. I don't think there is any bad news that should continue to pressure this down much more. I honestly think if this thing can come out with a reasonable earnings, they're probably going to get hindered on interest rates. I know everybody's against these kind of high infrastructure debted companies when it comes to interest, but the fact is eventually, and everyone argues on me with this, interest will come down, guys. I say this again and again because historically through every past any kind of just recessionary or weird economic event, interest skyrockets and then it comes right back down to a more moderate level. So if you want to buy these, infrastructure based companies, I don't know if they're going to rally aggressively this year, but you buy them on these dips and come back to me in like 1 to 3 years and something tells me you're not going to regret it. Eventually they'll be coming back to getting actually extended cash flows from the lower interest rated environment when we can get back to that event. Again, that's still speculative in nature. I know these are just my own personal opinions here, folks, but we'll take a listen to Steve Eisman. I'm going to break some of these clips down here because he does offer some insights on even his thoughts on the current banking environment and what's just going on here.
But are you in the category of this just keeps running? That's your view? Is your view that this has made a nice little run, take some profits off the table and wait for the next run? I mean, what's the strategy?
I mean, we don't sell much because we've had positions for so long. The tax, in the past, the tax implications weren't so great. Today, the tax implications are onerous. So if you sell something that you have a big gain in and you pay a 35% tax
right,
and you put it in treasuries for 5%, which isn't bad today, you're down a lot.
This is one of like the worst things you could ever tell a retail investor. This is why I don't like buying into like mutual funds or private funds, because of this exact reason. They get taxed at different levels. Here in Canada, you only pay capital gains tax on 50% of the income at your marginal rate. So I mean, 50% of the gains are completely tax-free. And in a moment where you probably doubled your money in a year, if you were lucky enough to be buying the tech at extremely discounted values, and now they're overweighting your portfolio, this is the opportunity to take some of those profits and diversify and protect yourself, because there are big regrets that can't come. I mean, you looked at Meta. I mean, that thing dropped from $300 to what, $90 a freaking share, and you don't want to be in that situation where things are so glorious today and you get so frothy at the mouth about it that you don't actually take the profit or lock anything. I think it's a massive mistake, especially when things become over leveraged in your portfolio, but that's just my opinion.
So we'd rather stick with positions and just hold them, and if they're working, that's great. If they're not working, that's okay. Because of the tax implications.
They're so dumb, man. Like even with tax advantaged accounts, like if you live in Canada, the US, you use your 401ks, use your RSPs and TFSAs, guys, because then you don't even have to worry about tax implications on profitable gains and stuff like that. Again, this is why I think it's so ridiculous when I hear these big fund managers just complaining about, oh, I'm not going to sell anything because of tax. It's like, you're up. Imagine making over 100% in 6 months and being like, we're not going to take profit. We're never going to take profit. No, tax implications.
When you think about the Federal Reserve, how much does that play into your thought for the rest of the year? We keep thinking that maybe there's one more increase, but maybe there's two. Maybe
there's three.
Maybe there's three. Okay.
I mean, there's no evidence.
Does it matter to you?
I mean, it matters to the extent that the higher rates go, the more negative impact it tends to have on growth stocks. So yeah, it does matter. The only caveat I would say is after the Fed raises rates, Powell will speak, and if history's any guide, Powell will be dovish even when he wants to be hawkish. That just tends to be his personality.
As somebody who did call the financial crisis right, what happened? 3 months ago, all we did around this table was we had different guests come on to hyperventilate about the banks, in particular about commercial real estate and what it was going to do to the regional banks, how that was going to create a death spiral. All of a sudden, either that has been forgotten, maybe people have their blinders on. I don't know what is going on, but that has somehow been removed from the discussion.
The banks have had a very large melt-up in a very short period of time. I mean, earnings season has not been good for the banks. If you look, at the earnings, I'll give you an example. State Street came out and said that their deposit beta is over 100%. And what that means is if the Fed raises rates, let's say 25 basis points, they have to increase what they're paying their customers by more than 25 basis points. I've actually never heard of such a thing in the history of banking. So, I mean, my expectation is that...
I mean, you'd be short the banks at this point?
The problem with shorting the banks is that they're still cheap. A lot of people are short. You know, what happened in earnings season was it wasn't a disaster. And so people covered I think people thought they would cover the stocks would buy. And the other thing is that things like, commercial real estate and other types of commercial stuff, it doesn't implode overnight. It has a long life before things start to get bad. So when it gets bad, the regional banks will have problems. But that could...
Yeah, this is the funny thing. He's really kind of covering his ass here, considering we did a quick review on this where he was saying the banks are interesting. I wouldn't buy the bank. They're going to have horrible earnings, all this stuff. And now all of a sudden banks are melting up because, again, like you can only get so oversold in companies, even in kind of a badder earnings period. And as mentioned, you want to pick the banks that have record revenues. I mean, look at things like JP Morgan, Royal Bank, Toronto Dominion Bank here, where they have to put loan loss provisions aside. Obviously, there's going to be some financial turmoil within these companies for the time being, but they're too big to fail, first and foremost. They're trading at far too cheap multiples, and eventually, yeah, there's going to be issues probably with some kind of aspects of office and commercial bank. All of this stuff will slowly bleed in, but they're going to be able to survive this stuff because it's not as impactful as the entire housing economy collapsing. And then on the other side of this, in a year or two, these banks who would have bought extremely discounted levels where they can afford the payout ratios on their dividends are going to be trucking back up. They're going to go up like tech stocks have gone up. Eventually, they'll go back to a nominal level where you probably make an excessive return on the capital gains and dividends over the next 3 years. It's just my opinion, right? But I just think it's funny how negative he was, and now he's kind of flip-flopping the other way.
Be 6-9 year from now.
So I think we all love your optimism. Is there something you worry about right now?
I mean, the one thing I worry about is that, look, the Fed has raised rates a lot. It's certainly possible that will have a very negative impact on the economy, and I'm very worried about that. But there's no data to support it at this time.
And boom! I love that. Everyone is just so negative on the market, and there's just no data to support it. Exactly that. For as long as employment stays high, for as long as housing isn't cracking at the seams, I mean, I just can't foresee this not being a soft landing, guys. I mean, it's this bull bear case right now where people understand things are overbought, which is going to lead into some profit taking. But like Steve Eisman said, like this is that small window of opportunity where things might fall off a little bit, but don't expect them to just drop. I mean, I'd love to see Tesla at $100 a share again, but the likelihood of that, I highly doubt it. So if things start to sell off, just start cost averaging to the downside if you have some individual positions you love, or take advantage of some of these highly discounted dividend stocks. You can just buy them in ETFs like I do with SCHD and just keep taking advantage of it, because I feel like this is going to be the bull run of the lower half of the market. Will probably takes a breath. Just my opinion, but I'd love to know what you think in that comment section below.